Picture this. It's 2021. You're sitting at a kitchen table in Fresno, California. Your neighbor just sold his 3-bedroom ranch house, the one with the cracked driveway and the lemon tree that never quite produces lemons, for $487,000 in cash in 4 days to a buyer in Seattle who never set foot inside. You think, that's insane. Then, 2 years pass, mortgage rates go from 3% to 7% practically overnight. The headlines start screaming, housing crash incoming, California real estate on the edge. Every YouTube channel, every Reddit thread, every financial podcast is talking about the great California housing collapse. And then, nothing collapses. Prices barely moved. In fact, right now the median home price in California is hovering around $854,000. That's not a typo. $854,000 for a median home in a state where the average household income can't come anywhere close to affording it. So here's the question nobody is asking clearly enough. If rates doubled, if affordability cratered, if regular people got completely priced out of the market, why didn't California home prices actually crash? And here's the follow-up question, the one that keeps economists up at night. Are they starting to drop now? The answer to both questions is yes, but not in the way you've been told. Let's be honest about what's happening in 2026. The California housing market is not crashing, but it is cracking. And understanding the difference between those two things is worth your time because the mechanism behind it is unlike anything we've seen in modern American housing history. First, let's talk about who this affects. If you're a renter in California, you already know that home ownership feels like a fantasy that the state keeps dangling in front of you just out of reach. Only 18% of California households can currently afford a median-priced home. 18%. That means 82 out of every 100 families in this state are priced out, not by a little, by a lot.
If you're a homeowner, you're probably sitting on equity that would have seemed like science fiction 10 years ago. And you might be wondering whether to sell, whether to hold, whether prices are about to slide and take your net worth with them. And if you're watching from outside California, maybe you're in Texas or Ohio or Florida, this matters to you too, because what happens in California's housing market has a long history of spreading. Trends start there, then migrate. The economic behavior of the country's most populous state doesn't stay contained. So let's actually break this down. To understand why California home prices behave the way they do, you need to understand a few basic rules about housing markets that most people get backwards. The first rule, prices are not just driven by demand, they're driven by the relationship between supply and demand. And California has had a supply problem for decades. The state has been underbuilding housing since roughly the 1970s. Zoning laws, neighborhood opposition, environmental regulations, permitting delays, pick your villain, the result is the same. California has millions fewer homes than it needs. NAHB, the National Association of Home Builders, estimates there's a nationwide shortage of about 1.2 million housing units. California carries a disproportionate share of that deficit. So even when demand slows, even when buyers get priced out, even when mortgage rates spike, prices don't fall dramatically because there's simply not enough product on the market for sellers to feel the pressure to cut. That's the first layer. The second layer is the one that's been quietly strangling the market for the past 3 years. Economists call it the lock-in effect, and it's the most important thing happening in housing right now. Here's how it works. Between 2020 and 2021, the Federal Reserve dropped interest rates to historic lows to prop up the economy during the pandemic. Mortgage rates fell below 3%. Millions of Americans, including millions of Californians, refinanced their homes or bought new ones at those rates. Monthly payments that would have been $3,000 suddenly became $1,800. People locked in those numbers and exhaled. Then, in 2022, inflation hit. The Fed hiked rates aggressively. Mortgage rates climbed from 3% to over 7% in less than 18 months, one of the fastest rate increases in American financial history. And here's where the trap closed. If you're a homeowner sitting on a 2.8% mortgage, you are not selling. You would be insane to sell, because the moment you sell, you have to buy something else, and that something else is going to carry a 6.5% mortgage. For a similarly priced home, that gap is roughly $1,200 more every single month. For a $700,000 home in California, that gap is roughly $1,200 every month for 30 years. According to the California Legislative Analyst's Office, about 77% of California homeowners currently have mortgage rates below 5%. Think about that. 3 out of 4 homeowners in this state are financially trapped in their properties, not because they can't leave, but because leaving makes no financial sense. The Mortgage Bankers Association has estimated that the lock-in effect pulled somewhere between 1.3 and 1.5 million homes off the national market every single year. Homes that would have been listed under normal market conditions simply weren't, vanished like they never existed. The result was a paradox that broke every standard model. Higher interest rates are supposed to cool a housing market. That's textbook economics. Higher rates make mortgages more expensive, fewer people can afford to buy, demand falls, prices drop. We all learned this somewhere. Except that logic has a gap in it. It assumes there's supply. In California, there wasn't. Higher rates priced buyers out, yes, but those same higher rates kept sellers frozen. So you had fewer buyers and fewer homes, and when those two things happen simultaneously, prices don't crash, they just sort of stall. They become eerily, stubbornly, maddeningly stable.
Now, let's get into the numbers that nobody really wants to talk about. In December 2025, California's statewide median home price dropped to $850,680, down from $861,020 the prior December. That's a year-over-year decline, small but real. The second such annual decline in 3 months, and the largest year-over-year drop since June 2023. In Northern California, the picture is sharper. Zillow's data shows several markets facing projected value declines through the end of 2026. San Francisco is looking at a projected drop of around 5%, Eureka, 7%, Ukiah, approaching 9%. These aren't rounding errors. These are real losses, in real dollars, in specific places. In Southern California, as of May 2026, the average home price across the 6-county region fell 0.2% from the same month in 2024, the first annual decline in that region since July 2023. Now, before you start thinking this is the beginning of a freefall, let's look at the full picture. The California Association of Realtors is forecasting the statewide median to reach $905,000 in 2026. That's up 3.6% from last year. So we have pockets dropping and the headline number rising. How does that make sense? It makes sense because California is not one housing market. It's dozens of micro-markets layered on top of each other, all behaving differently based on local employment, local inventory, and local wealth. The Bay Area is softening because tech employment has been contracting. Remote work reduced the premium people are willing to pay to live near an office, and high-income buyers have become more selective. San Francisco is also dealing with a narrative problem. The perception of the city has shifted dramatically over the past few years, and perception in real estate is very nearly everything. The Central Valley, parts of the Inland Empire, some of San Diego's suburbs, those are still holding firm or even climbing slightly because demand from residents who can't afford the coast continues to push inland. But here's the mathematical reality that sits underneath all of this. Only 18% of California households can afford to buy a median-priced home. In 2019, before the pandemic, before the rate hikes, that number was around 31%. In 7 years, the pool of potential buyers in California has essentially been cut in half. And here's what makes that number truly alarming. It's not just about mortgage rates, it's about income. The income required to qualify for a mortgage on a mid-tier California home right now has risen far faster than actual California household income. You need to be earning somewhere in the neighborhood of $200,000 a year to comfortably buy a median-priced home in the state right now. The median household income in California is around $91,000. Do the math. The market has self-selected. The only people who can participate are people who already have substantial wealth, from equity in a previous home, from inheritance, from stock compensation at a tech company. Everyone else is renting or leaving.
Every 6 months or so, a new wave of content appears telling you California real estate is about to implode, crash imminent, price collapse incoming, get out now or be trapped forever. And every time, the crash doesn't come. Prices dip, they plateau, they nudge upward. The people who waited for the crash are still waiting. Here's why those predictions keep missing. They underestimate the stickiness of California homeowners. These are not investors holding speculative positions who will panic sell at the first sign of trouble. These are families who have lived in their homes for years, who have mortgages they can comfortably afford, who have no financial reason to sell at a loss. The distressed seller that drives price crashes, the one who bought at the peak with maximum leverage and can't make payments, that person largely doesn't exist in the current California market. Foreclosure rates in California remain historically low. Unemployment, while elevated from its pandemic lows, hasn't spiked to a level that would force mass selling. The conditions that produce a housing crash, forced liquidations, rising defaults, panic, aren't here. What is here is something more subtle and, in its own way, more troubling. The market has frozen in a position of unaffordability. Prices aren't crashing, but they're not accessible either. And a market that prices out 82% of its own population is not a healthy market. It's a market running on fumes and inertia. This is the part that gets glossed over in both the bull and the bear narratives. The bulls say, prices are holding, the market is resilient, California real estate always bounces back. True, partially. The bears say, prices are about to collapse, rates are too high, nobody can afford anything. Also partially true, but the timing has been wrong for 3 years running. The more accurate read is this: California housing is not crashing and it is not recovering. It is quietly, slowly, structurally breaking down the conditions that made it function as a market in the first place. Here's where we get to the part that matters most, right now in mid-2026. The lock-in effect is starting to loosen. Not because rates dropped dramatically. They haven't. The 30-year fixed mortgage rate in California is sitting around 6.54% right now. That's not cheap, but something else has happened. Life continued. The homeowner who locked in a 2.9% rate in 2021 has now had 5 years pass. Kids grew up, jobs changed, divorces happened, parents died and left houses behind. People who swore they'd never sell are selling, not because the math got better, but because the math became irrelevant to what they actually needed to do with their lives. The Mortgage Bankers Association's own data reflects this. The share of mortgages carrying rates above 6% has been growing. More homeowners are now in the 6% territory, which means the psychological and financial barrier to selling is lower for a growing segment of the market. The result? Inventory is rising. Nationally, inventory increased by about 15% in 2025 and is projected to rise another 8.9% in 2026. In California specifically, as of March 2026, there were over 103,000 homes listed for sale statewide. That's still not a lot by historical standards. The average months of supply is only about 3 months, and a balanced market wants 4 to 6, but it's movement. And movement in a market that has been essentially frozen is significant. More inventory means sellers have to compete. More competition means price cuts. The share of California homes that had price drops is rising. In March 2026, about 24% of listed homes saw a price reduction, up from 23% the year before. Small numbers,
but directional. Meanwhile, sales volume tells a quieter story. Home sales volume in California in early 2026 is running about 20% below 2019 levels, the last normal year before the pandemic distorted everything. 20% below normal in a state of 40 million people. That's not a market, that's a parking lot.
Let's zoom out. California has, for generations, been the aspirational destination, the place people move to chase an industry, a climate, a version of their future. The housing market reflected that. Demand was always there. Prices rose because people kept arriving, and there was never enough room. That dynamic is changing. California had net domestic outmigration in 2021, 2022, 2023, and 2024. For 4 consecutive years, more people left California for other states than arrived from them. Texas, Florida, Arizona, Nevada, they've all been absorbing California's middle class. The people leaving aren't the wealthy homeowners. They're the renters, the workers, the teachers and nurses and construction workers who looked at a $900,000 median home price and did the math and decided to live somewhere their money had meaning. This matters for the housing market in a subtle but important way. California's price floor has historically been supported by consistent demand from people who wanted to be in California no matter what. That floor is showing early signs of erosion, not because wealthy buyers are leaving, but because the population of aspirational buyers who would eventually become middle market buyers is shrinking. There's also the insurance crisis, which is starting to show up in home values in specific markets. Several major insurers have pulled back from California or dramatically raised premiums, particularly in fire-prone areas. A home that becomes uninsurable or only insurable at $30,000 a year is effectively repriced whether the seller likes it or not. And then there's the tariff environment of 2026, which is adding uncertainty to construction costs and slowing the already sluggish rate of new home building. Fewer new homes means the supply problem doesn't get solved, but economic uncertainty also chills buyer confidence. Both of those things are happening simultaneously, and they pull prices in opposite directions.
So where does this leave us? California home prices are not crashing. The structure of the market, the lock-in effect, the chronic undersupply, the resilience of existing homeowners, all of those forces are real, and they are working against a dramatic decline. But California home prices are also not fine. The affordability math is broken at a level that is difficult to fix without a dramatic price correction, a dramatic income increase, or a dramatic expansion of supply. And none of those things are happening quickly. What we're likely to see, in what the data from late 2025 and early 2026 is beginning to confirm, is a slow, uneven, market-by-market softening. Not a crash, a leak. San Francisco and other high-cost urban cores losing ground first, the ripple effects taking longer to reach inland markets, inventory creeping up, days on market extending, the percentage of homes selling above list price declining. For buyers, this is the most nuanced environment in decades. If you're waiting for prices to collapse before you buy, you may be waiting for something that doesn't come in the form you expect. But if you're stretching beyond your means on the theory that California prices always go up, you might be betting on a historical pattern that's being tested in real time. For sellers, the window of maximum leverage is quietly passed. You can still sell at historically high prices, but the frenzied multiple offer situations of 2021 are gone. The market is asking for your patience and your realistic expectations. For renters and first-time buyers, the picture is the hardest to sit with. The market isn't falling far enough fast enough to bring you in, and the structural forces keeping prices elevated aren't disappearing anytime soon. The state's housing shortage is a decades-long problem that will require decades-long solutions. The politicians know this, the developers know this, and the math knows it too.
Here's what nobody has a clean answer to. California has built its identity, economic, cultural, social, around the idea that land here is valuable because people want to be here. that the prices make sense because California is worth it. But at what point does the price become the thing that makes California not worth it? At what point does a state price out enough teachers, enough nurses, enough engineers, enough young families that the very things that made California worth the price begin to disappear? That's not a hypothetical anymore. It's a process that's already underway, and the housing market is the ledger where it's being recorded. Prices may hold, they may even rise, but the question isn't whether California real estate can maintain its price tags. The question is whether California can maintain its reasons for them. And that question doesn't have a Zillow estimate.